Welcome to Your Business, Your Life with Matt DeFrancesco, your personal financial technician. Whether you've had years of success in your business or are just starting out, HighLift Financial can help you create a vision for your business, life, and family, and align these for generational wealth. So as they say, what happens in your life affects your business. And now, on to the show. Well, hello, and welcome back to Your Business, Your Life with me, Matt DeFrancesco. And again, this is the third part of our educational series with Stuart Sorkin. We just got through kind of drinking from the fire hose on C Corps and the benefits and at times that you might want to look at one, and also some of the disadvantages too. But I think really, in any situation, we need to look at personal protections for the business owner. So Stuart and I, we're going to talk a little bit about buy-sell agreements and why they're important and some of the misconceptions. I mean, there's a lot of times where I'll see, especially if you have partners, and again, we've been talking about with the C Corp, if you're having employees or family members be, all of a sudden, buying stock, they are now owners too. So how do we protect against some of the unplanned events that are out there? So Stuart, I want to welcome you back to Your Business, Your Life.
Thank you very much.
No problems. So let's just talk a little bit about just kind of the exit planning processes on a very top view, and then we'll kind of drill down here.
The idea with succession planning for most business owners is the antithesis of their strengths, because what made them successful for the most part was their belief in themselves.
Right.
If you are creating some form of succession plan, you are no longer the smartest man in the room, and you have to learn to delegate.
Right.
So there is the psychological sides of a succession plan that need to be factored in. And within that framework, the first thing that I tell clients they need to do is you're doing this for a reason. You want to have a successful retirement when you exit. You want to provide a certain amount for your children and anyone else. Well, how do you know learn what that number is? And that by going to someone like Matt or financial planners, they do what's known as a Monte Carlo analysis. And basically, the Monte Carlo analysis tells you the amount of money you need with a 90 to 95% certainty to achieve all of your financial goals. Or in other words, how much you need to be able to say, take this job and shove it.
Right.
And basically, the way they run through 10,000 or more simulations of the market based on your usage, and they will tell you what your number is.
Right.
So part of the first question then is, you get this number. If your business is if you're already there, then you can start doing tax planning, legacy planning. I had one client that his number was better than $1 million more than what he needed. And instead of selling it to a third party, he sold it to management because he said, I'd rather sell it to them if I don't need the money.
Right.
So the Monte Carlo analysis is really a key thing in setting up.
Right.
But the other side is,
good.
What if you're not there? How do you get there?
Right.
Can you do it through internal growth, or do you have to become a strategic acquirer? And if you're going to become a strategic acquirer, what are you going to acquire that's going to maximize value? Because acquisition for the sake of acquisition doesn't necessarily grow value. Right. So you have to have a plan for that. What is your time for exiting? If you want to be out in 6 months, all the things we're talking about are almost impossible. Exactly. If you're going to give us anywhere from 1 to 5 years, we can do a lot.
Right.
But we need to know, what is the timing realistically of doing this?
Right.
What are you going to do with the sales proceeds? Are you going to just invest them? Are you going to do another business? If you're going to do another business, then maybe part of this has to be some creditor protection with some of the sales proceeds. So if the next deal doesn't work as well, you haven't risked everything.
Right.
The question that is really important, which we have to figure out in order to really figure out what you have as value, is what happens to this business if you got hit by a bus?
Yeah.
If you're the sole owner, what do? If you have partners, can your partners take up all your slack, or do you need to fill a hole? One of the things is looking at is, as the business owner is, what are all the things that you do that no one else does?
Yeah.
And figuring out then who should do them if, God forbid, something happens.
It's the who's, not the hows.
Right. And within that framework, you can have partners, you might have management.
Right.
Now, management may not want to buy. So tying them in with equity might not work.
Right.
But for a client that Matt and I worked on together, who is right now in cancer remission, and he was concerned that his team said, we don't want to buy. We want a job as long as this place is running. So we had them each sign an employment contract that said that if this owner made a planned or unplanned exit from the business and they stayed a minimum of 12 months afterwards, they would get a bonus equal to 50% of their W-2 income.
Right.
That was enough to motivate. Now the founder's not as worried. He can look at alternative structures. He's got a locked-in management team if he does go into remission. Plus, the way the agreement is worded, it's planned or unplanned. So he has now locked them in potentially for a sale to a third party with that bonus structure.
Right.
What does your family know about this business? Oh, I'm sorry. I want to go back to one other piece.
Okay.
What happens if you don't have management? You don't have partners. Can you create at least some form of succession plan? And what I have suggested to a couple of people, and they have done it, is who is probably the best person to run your business if something happened to you? Your biggest competitor.
Right.
So if he is close, why not go to him, because he is in the same position, and say, look, I don't want to buy your business now. I don't want to sell my business now. However, we both got a problem. If something happened to us, someone's going to come in on a fire sale. How about we sign an agreement to cross life insurance each other? And has a valuation formula.
Mm-hmm.
And that way, if I die, you get the insurance, my family gets a note if there's anything different, but I know they'll get paid because I know you run the business.
Mm-hmm.
Same is true the other way. We are going to talk about this a little further with regard to partners and stockholders agreements, but the concept of, if you don't have an exit strategy, this is sort of the ultimate risk saver for someone if they don't have an exit strategy and they have competitors that are nearby.
Right.
Other issue is, you got kids in the business and outside the business. How are you going to handle? How are you going to equalize? What are you going to do? If you're selling for notes, what is going to happen to those notes if something happens to you?
Right.
If the business owns the real estate, are the non-business kids allowed in the real estate? What are you going to do to protect the real estate from potentially, the family selling it out from under the business?
Right.
These are all things that need to sort of be considered, and obviously it should be considered that your estate plan is up to date.
Right. Oh, definitely. All of these areas, I know, like when I'm starting to work with a client, and I remember I have some M&A people that I work with who they'll bring clients to me that are looking to sell and they want me to like do a lot of the back end stuff as far as financial planning. And I'm like, this really needs to be done upfront. And I think, before you even decide what the actual strategy is going to be, you need to have the financial plan, do the Monte Carlo analysis. You need to look at time frames, unplanned events. All this stuff I think needs to be done up front because, all of a sudden you have this liquidity event. And first off, what if it's not enough for you to live the lifestyle that you want? All right. And second, what if you've never protected anything and something happens to you? So I think sometimes we get it backwards. And I think really this is stuff that needs to be done on the front end. Then we start building the plan out. And then on the back end, that we can restructure stuff. But, having every one of these things, the estate plan, all this has got to tie in with the estate planning too. And it's amazing to me how few people even have just a basic world power of attorney and medical directives. I mean, so I think these are really important things. And I'm glad that you're tying all this stuff together because I think it's really important, Stuart.
Matt, I'm going to say something else with what we're talking about. And that is, if you're going to optimize the C corporation investment strategy, you need to probably try to maximize the amount of income that you can invest versus in lifestyle. And if you don't know what you're spending,
Yep.
then how can you budget? So the
Right.
point is, part of this is not only the Monte Carlo analysis, but really establishing some budgets so you know how much you can keep in the corporation and not have to borrow out or pay double tax on.
Amen.
That's the piece that is really key, is that it's not only what you're going to get at the back end, but if you said to some owners, hey, if you cut your expenses by $100,000, I'm going to add another $2 million to your back end sale. A lot of people would probably make that trade, but they don't know what they don't know about where they're wasting money and how they're currently spending it,
Right.
nor do they know what they really need on the back end.
Right. We're all like the little kids that get, mommy and daddy give them a couple bucks and put them in the pocket. What's happening? It's burning a hole in there. They want to find something to spend it on. I think we all have a propensity to do that.
And let me give you another quick little war story that you'll appreciate.
Okay.
I'm a big person who requires clients to try to do Monte Carlo analysis.
Right.
About 8 or 10 years ago, I got a call from a client screaming at me, saying, you told me if I use these financial planners and I did a Monte Carlo analysis, I'd never run out of money. And now they're telling me I got to cut my expenses by 20%. What the hell happened? And I very calmly said to him, you didn't bother to tell these financial planners of your love for Italian sports cars, of which you bought 3 in the first year and you took $1 million out of their analysis.
Right.
That's sort of, not only did you take the million out, but the earnings on the million were been there. So
Right.
that's why you have no money. So one of the things I say to my clients is, if you're going to meet with a financial planner, make sure you tell them your WTF budget is.
Thank you. Thank you.
If you love cars, or you're going to spend, redo your kitchen at $100,000 or whatever. When you go to that ATM and you see that amount in your bank account, your mind is going to wander and you're going to think it's always going to be there.
Mm-hmm.
I really caution you to do that kind of planning in advance so it really is there and you don't have a problem.
Right. And those problems always end up rearing their ugly head somewhere down the road too, right?
Exactly.
Yep. Yeah, exactly.
All right.
So let's talk about, some of the reasons
Okay.
why people should have buy-sell agreements.
As I said, as we've talked about, buy-sell agreements are really partnership agreements for an asset called the business.
Mhm.
And they can be broken up into management issues, how you're going to retain employees, what happens with third parties, death, disability, bankruptcy, divorce.
Mhm.
Divorce is a big one that gets missed a lot.
Oh, yeah.
Are you going to take investors? Are there penalties if someone involuntarily forced out? Termination for cause, other things like that.
Mhm.
These are things you need to agree on before the business is there, because otherwise you'll never get an agreement.
Right. And I think too many times, at least this is my experience, I see a lot of cookie cutter agreements and they don't address a lot of these other issues that are in there. And so all of a sudden they come there, they rear that ugly head and they've never addressed those issues. So I think it's being as thorough as possible, I think is really important.
All right, let's move to the next slide.
Yep.
Management decisions. What things require a supermajority? If you got a business and it's doing $2-3 million of sales, I don't think you'd want any one partner to have the ability to spend $200,000 for a new piece of equipment without talking to the other partners.
Right.
So what are decisions that should be potentially supermajority? I don't like unanimous consent, because especially if you've got some 1% and 2% employees that could be a pain, you got to be careful.
Right.
Another issue is, what happens if you need to put money in the business? What are the rules? Is it go in as a loan? Does it go in as an investment in capital? Do the other partners have to participate at some point? How do you deal with that?
Mm-hmm.
How do you resolve disputes? Let's say you got these supermajority decisions. The last thing you want is a litigation.
Right.
So the idea of setting up a methodology that is, I believe, something less than arbitration is most people, most business owners probably have someone that they trust. And the concept of whether it's attorney, CPA, someone else in the body shop industry, of saying, first go round, we both like this guy. If he told one of us, excuse the expression, you're full of shit, you probably listen to him and
Mhm.
agree with me. And so that's the first level, is to have someone who is not antagonistic, who's looking at it solely from a business decision, that's not going to be biased, to just say, no, I agree with one of you or the other, and hopefully that ends it.
Right. Makes sense.
Next is binding arbitration, which can be expensive, which is why I'm a big proponent of always having what I call a reverse offer. Sometimes known as the pizza theory, or sometimes known as a Texas shootout.
Texas shootout.
Concept is Matt and I are partners. We're not getting along. I go to Matt and say, I'll buy you for $1 million. I'll buy your interest for $1 million. Matt has a choice at this point. He can either sell at $1 million or he can buy me at $1 million. I have set the price.
Hmm.
So therefore, I'm not going to lowball because you're going to flip it on me. If I want the business badly enough, I'm probably going to offer you, Matt, 110% above what market is to make sure he doesn't flip it on me. If I'm neutral, I'm going to come in at market. And if I want to out, I may lowball.
Right.
So the point is, it's a way to get out. Your partners,
Right.
someone comes to you and wants to buy you. Do I have a right to prevent them from buying you out?
Hmm.
Can I buy you first? That's what a right of first refusal is.
Okay.
Now, here's the other one that gets missed a lot, which is someone comes to Matt and says, hey, I want to buy you for $1 million. I'm thinking to myself, there ain't no way I would ever pay Matt $1 million for his interest. So I can say to Matt, hey, Matt, that's a great idea. We're 60-40 partners. I get 600,000, you get 400,000, and we're selling him both our shares. So that way you don't get stuck with an unwanted partner.
Right. Okay.
Drag along is the concept that if a certain majority of the stockholders say we're selling, everyone has to sell. This
Right.
is really key. Where I've seen this go wrong is, client been in business 25, 30 years. They've given out some shares here and there to various employees. And the employees left. They never got the shares back.
Mm.
Now there's a sale. And that employee says, oh, you want my 1% that was only worth $1,000 to buy? You want me to sign up? No, it cost you 10.
Right.
So drag-alongs are really important. The last one that I also consider when you have a small company of one or two partners,
Hmm.
if you came to me, there are certain people that I wouldn't want to exercise the right of first refusal on or tag along rights, but I wouldn't want them as a partner, as a voting partner.
Right.
So this says, hey, I have the right to say the stockholders can vote and say, you can sell this, but they're only getting non-voting.
Hmm.
So therefore, it makes the seller find someone that the other remaining stockholders can live with.
Right.
Redemption issue.
Okay.
Okay. Death, disability, termination, bankruptcy, divorce. All those cases, you may not want them as a partner anymore
Right.
or as a voting partner anymore. So the question comes in is, what happens if someone has one of these events? Well, death and disability is a little bit better because you can buy life insurance for that.
Right.
However, if someone leaves or gets divorced, there's no funding necessarily to do that. So the concept that I tell clients is, if you are subject to one of these triggering events, your equity instantly becomes non-voting.
Hmm.
And non-voting equity is callable at any time by the corporation. But
Interesting.
they then have to buy it at the value that it's that when they call it, they don't want to continually grow the value for the partner that left. So they're going to try to execute this as quickly as possible. But you don't want to kill the goose that's laying the golden eggs by overstrapping.
Mm.
So the concept here is, and the concept of saying having the spouses sign this your buy-sell agreement that says if you are in one of those states that has equitable distribution and you get the actual equity, you get converted to non-voting, you get bought out on the same terms and conditions as any other stockholder, except there is no non-compete.
Okay. So in a divorce situation, the stock is converted to non-voting, they're bought out, and then let's say it's a no-fault state where it'd be 50-50. Then this one spouse would get 50%, the other one. Is that how that works?
Well, it's more, the issue is this. There are certain states where, like in Virginia, says, I don't care what the valuation experts say. We're not going to get into it in a dollar figure to make an award. I'm just giving her half the stock.
Okay. Okay. See,
That's where we're worried about. If they value it and so on, that's one thing. But it's the issue is that they actually can get the physical stock.
Yeah.
As the divorce, that's what we're trying to prevent here.
Gotcha. Gotcha. And even if she gets the stock, that there's non-voting shares, so she has no control.
Correct. And she gets bought out with cash and a note, which she would never get in the divorce.
Right.
So you don't necessarily strap the company.
Okay. Okay.
Okay.
Yeah.
Also, depends on how many partners you have of whether the company should buy it or your partner should buy it. Because if the company buys it, you get no increase in your basis for tax purposes. So if you're going to turn around and sell in 2 years, it may be better for you to buy it. So you could, that shares you bought from your partner have increased your tax basis, so you pay less. But on the other hand is if you're saying, I'm not sure where I'm going to go, if I want to continue this or not.
Right.
Having it in the entity gives you more rules.
Okay.
Okay. Annual mutual agreement of the owners. Standard fallback position.
Okay.
That position in a stockholders agreement that I didn't prepare resulted in a 7-year litigation.
Oh boy.
And let me tell you why. We had a body shop that originally had 10 people down to 3. 2 workers, one who was actually a car salesman who now retired. The site ends up being across the street from Potomac Yards. New, massive. So the investor sees big dollar signs for this real estate.
Right.
These guys are saying, no, we are on a main street. We have the environmental permits. We don't have to go with the highest and best use.
Okay.
Because they had no default. It had to be unanimous agreement of the owners. It took 7 years to get the case settled.
Oh boy. Wow.
Okay. With body shops, some of my clients say, well, if it's an internal sale, I'm going to use 50 or 60% of gross sales. I don't need a valuation guy. It's an internal sale. They shouldn't, if it's a partner and we're staying in, they shouldn't get 90. They should get, they shouldn't get market necessarily.
Right.
But you then have the appraisal rights. But another issue that gets lost sometimes is the guy that dies is the principal mover of the business. And the business, what it was worth the day before he dies and what it's worth a year later is significantly different.
Correct.
Therefore, the remaining partners are now having to give up 99% of their disposable income to pay the spouse for the overvalued equity. How long are they going to do that?
Right.
So what I provide is that the buyer has the right after 12 months after the acquisition to have the company revalued. And if the revalue, and we set a hurdle rate, we say, we would have expected a 20% fall off in business because Joe died.
Right.
Falls off less than 20%, no harm, no foul. If it falls off by more than 20%, you use the revalue and you cut the note.
Okay.
But that way you're not. Two other issues, obviously, is if you terminate someone for cause,
Okay.
they should get a haircut in their price.
Right.
The other one is I provide that they have to stay. If you're a stockholder, that means you're a key employee.
Right.
Therefore, you have to give them minimum notice.
Mm.
If you don't, we're going to haircut your price.
Ah, that's a good point. Okay.
You know, guy goes middle-aged crazy and says, I'm going to Tahiti next week, have a nice life, buy me out of my equity. We say, great, we'll buy you out of your equity, but that just costs you 20% of the value.
Yeah.
Okay? Again, understanding where these things blow up, Matt. As I said, this is a business prenup.
So that's a great term. I'm going to steal that one if I could. So,
Yeah, it's your business prenup.
right.
All right, we'll go on to probably the most important one in my mind.
Mhm.
Don't kill the goose that lays the golden egg.
That's right.
As we talked about, we should cut the price if you leave early or you committed a bad act and were terminated by cause.
Right.
We should allocate a portion of the purchase price to a covenant not to compete that's going to be paid over the covenant period, so you have an enforceable covenant. If you're going to have, if it's a retirement, but you're going to be set up, what are the consulting payments? Because those are currently deductible versus non-deductible equity payments.
Right. Okay.
So how do you structure that?
Mm-hmm.
How do you restructure if one of the partners is a guarantor on your loans? How do you get him off? The trick I have used is, depending on the size of the loan, have the company go in and say, I will set up $100,000 letter of credit that you can claim against if we default.
Right.
If you release this guy.
Mm.
So most times banks will say, you're going to leave me completely secured with cash.
Yeah.
And I'm still going to chase the other three of you, and I'm releasing one guy. I think I can maybe make that deal.
Right. Exactly. Okay.
So it's the point is you're giving the bank something for giving up something.
I got you. Right.
And I will let you talk about the different types of disability insurance and life insurance issues.
Right.
But the real issue is, after the new Supreme Court case, that if the company owns the life insurance, you've just increased the value of that company by the amount of the death benefit, and that pro rata ownership of that death benefit is now in your estate.
Right.
So the idea cross purchase works really well if it's one or two. If not, if you have more than two, then I'm a big believer in setting up a trust or an escrow agreement. And the one advantage of a trust or an escrow agreement is that the company sends me the checks. What they do is they W-2 the checks, the amount of the premiums, to the employee, gross it up for taxes, and therefore they've now made what was non-deductible insurance payments deductible.
That's a neat strategy, especially with multiple owners, more than two.
Right. If you got 3, 4, 5 owners, they have an additional bonus, unlikely it's ever going to get picked up.
Right, exactly. You know, it's interesting. There's actually a client I'm working with now where his key guy is buying into the business. So we're working on a cross purchase. My client, the owner, is 65. He's looking probably maybe in 5 years, maybe he'll end up transitioning out and selling the remainder of the business. So what we're doing is we're doing a convertible term policy that in 5 years, when he's 70, we can sell that. All right.
Right.
Now he gets proceeds from that too, but the insurance is no longer needed.
Well, here's the other thing that you could do depending on his health issues.
Right.
I had one with a health issue. I did a second to die life insurance policy.
You could do that.
Get insurability.
Yeah.
And said everything goes to the survivor, so therefore there's always cash there to pay off uncle when time comes.
Right, exactly.
That's an alternative.
Oh, the other thing, and I wanted to talk because you mentioned about disability insurance, and I think two areas that business owners miss is first off, you want personal disability insurance, basically to protect your own income and your family's income, but you also want business disability insurance that's going to provide funding to the business in the event that you become disabled. Because again, even with life insurance, you may want to have some type of you talked about the scenario where one of the owners is kind of a key guy and having some sort of key person insurance. Well, if it becomes disabled, you can't use life insurance, but they have business disability policies that can then provide funding in case the owner is disabled for a long period of time, that can continue to provide funding to either hire somebody to take over whatever his position is or to fill in on that, and also to help any operating expenses if there should be a dip because of this guy not being able to function in the business.
Matt, I thought there were actually two types in that level. There was overhead insurance
There is, yes.
versus something that's almost the equivalent of a life insurance policy with a big payment if you're disabled.
Yeah, you can do both of those. Yes. That's the big thing. You want to make sure that there's funding for the business and also protection for the business and also for the owner's personal income.
Yep. Third party financing, what I will say to you is that I have a lot of situations where clients say they want a big down payment from the bank to close the deal with the employees.
Hmm.
But when they look at what the cost is of that loan and the interest rates, they then look, maybe I want to do more seller finance.
Ah,
That's the issue is the trade is that you're creating a fixed significant obligation on the ongoing business to the extent that you make them go to the bank
hmm.
and buy out the founder. And so there needs to be a trade-off of, yes, I want a lot of cash up front. On the other side of the coin is you want to get paid the remaining purchase price. You don't want them to go under because they can't. That's the trade. And the other point that, as we sort of talked about, is the seller financing can be either in the form of a note
Hmm.
or it could be preferred stock.
Ah, okay.
And the note, you have fixed payments, but those have to be made regardless, versus a preferred stock could have a fixed value or a growing value and only gets paid if there's money there. The dividends could be cumulative or non-cumulative, but the dividends, when they're paid, are going to be paid at dividend rates, so they're more favorable. So
Right.
there are a couple of issues when people talk about seller financing, they instantly look towards the note.
Yeah.
If they're doing like SBA financing or it's a consolidator, you're probably talking about 100% buyout, so they're not going to allow you to do that. But
Right.
if you're talking more of a management deal or a transition deal over time,
Hmm.
this may be a better deal.
Yes. I think that makes complete sense. Okay.
I,
Any
I
final
think that's
thoughts?
it. My final thoughts are you need to plan.
Yes.
The whole the adage goes that most business owners spend 99% of their time working in their business and 1% on. I
Right.
strongly encourage you that you need to spend a chunk of time to think through the on,
Correct. Yeah.
because growth doesn't happen without planning. And unless you can create measurable, achievable goals with accountability for your employees, you will not have maximize your value. And you can only do
Right.
that if you have a plan.
Exactly. Planning is key. And, what do they say? Most people don't plan to fail, they fail to plan. And I think it's also important as you're doing this planning to put a team together. Okay. My core business is financial planning and financial advisory. I don't profess to I can't write legal documents. I know enough about this stuff to be dangerous. I want to bring somebody like Stuart on my team and I want to bring good CPAs and whoever might be involved in the process. If we're looking third party sale, do we need business brokers, M&A people? Getting a team together is really just going to make first off the planning much more effective, okay, and is going to help to address any unforeseen issues that can come up. So I know that's one thing Stuart's talked about in all of these sessions is, again, we've got to kind of address all the different situations that could come up, because it's amazing to me. I mean, I've run into clients who, kids get involved in the business and they're like, oh, divorce is never an issue. And guess what? The marriage falls apart. And then now all of a sudden there's a fiasco that happens. So Stuart, I really appreciate what you brought to us, brought to the audience. We're going to have you on again. I think there's more of these type of educational things that we can do. Again, thanks for being on.
My pleasure. I love working with the auto body industry, and Matt will provide my Calendly link.
Yep.
And if you would like a complimentary call to discuss your particular situation, you can go on my website and I will be glad to do a complimentary call with you to talk about any of the particulars.
That's great.
Again, thank you for your attention.
No problem. We'll have all of Stuart's contact information in the bios, in the show notes. And again, you can also reach out to me at highliftfinancial.com. Click on the Let's Chat. And of course, if I need to bring Stuart in, I don't hesitate to do that. So again, the last thanks always goes to you, the audience. Thank you for listening to Your Business, Your Life. And if you've not subscribed to the podcast, click the subscribe button below. That way, when a new episode comes out, it'll drop right onto your device. If you're watching on YouTube, please give us a 5-star review. And hopefully you have been watching this on YouTube, because we've got some great slides too. So if you've only listened to the podcast, go to the YouTube channel, High Lift Financial, or you can go to the website at highliftfinancial.com, and up on the top, you'll see DFran Digest. We have all of our content archived there so that you can at least get to see the video too and see the slides that we've been talking to. So with that, again, I want to thank everybody. We'll see you again next time, and take care and God bless. Hey, I really want to thank you for listening to the Your Business, Your Life podcast. If you want to be notified when new episodes become available, click the subscribe button below.
All information is obtained from sources deemed reliable but not guaranteed. No tax or legal advice is given nor intended. Content provided herein or on our website should not be construed as an offer for investment advice or for securities, insurance, or other investment products. Investments involve the risk of loss and are not guaranteed. Consult a qualified legal, tax, accounting, or financial professional before implementing any investments or strategy discussed here. High Lift Financial is a DBA for DeFrancesco Financial Concierge, LLC. Investment advisory services are provided through Cornerstone Planning Group, LLC, an independent advisory firm registered with the Securities and Exchange Commission.